Most traders look at volume and ask one question: is it high or low? Professionals look at the same volume and ask an entirely different question: does the price movement justify what the volume is telling me about who is actually in control? Those two questions are not variations of each other. They produce completely different reads of the same chart, from the same bars, at the same moment. And the trader asking the second question is positioned before the move. The trader asking the first is still confirming whether the move already happened. This is not about indicators. This is not about software. This is about understanding what volume is actually communicating, not as a secondary signal below the price chart, but as the primary evidence of what the market's participants are doing at every moment. And most traders, even experienced ones, are reading less than half of what volume shows them every session. Every candle tells you what price did. The volume beneath it tells you whether to believe it. Consider what volume actually measures. Volume is the number of units, shares, contracts, currency pairs that changed hands during the time period represented by a candle. If you are looking at a 1-hour candle with a large volume bar beneath it, it means a large number of participants were actively buying and selling during that hour. But here is what the textbook version of volume analysis never addresses: the relationship between the size of the price movement that candle produced and the volume that produced it. That relationship, what professionals call the effort versus result, is the single most informative piece of data on a chart, and it is visible to anyone who knows to look for it. An amateur asks whether the volume is high. A professional asks whether the price result is proportional to the volume effort that produced it. Here is the complete framework. Every candle on every chart in every market produces one of 4 volume relationships. Understanding all 4 is what separates traders who read volume from traders who glance at it. The first is high effort, high result. Large volume produces a large price movement. This is the conviction candle, the bar where one side is clearly dominant and the market is moving with commitment and participation. Buyers are overwhelming sellers, or sellers are overwhelming buyers, and price is moving decisively in one direction on strong volume. This is what most traders think of when they think of a strong candle, and they are correct to think this. A high-effort, high-result candle in the direction of your trade is confirmation that the move has genuine participants behind it. The second relationship is low effort, low result. Small volume produces a small price movement. This is the disinterest candle. Neither buyers nor sellers have conviction at this moment. Price is drifting without commitment from either side. On its own, this is information about the market's current state of indecision. In a series, a sequence of low-effort, low-result candles clustered together, this is the signature of a compression setup forming. The market is coiling. Energy is accumulating. This pattern preceded every major compression breakout covered in the earlier video on dead zones. The third relationship is the one that produces the fastest profits and the most confused traders. Low effort, high result. Small volume produces a large price movement. This is the vacuum candle. Price moving easily because there is almost no opposition. In a vacuum, a small number of buyers or sellers can push price significantly further than normal because the other side has temporarily withdrawn. These moves look dramatic on the chart. They feel like the beginning of something explosive. They are almost never what they appear to be. A vacuum move cannot sustain because it has no committed participants behind it. Price moved far with little volume, which means the participants who created the move will not be there to defend it when price begins to reverse. Vacuum candles are the most frequently misread signal in technical analysis. Amateurs enter them convinced they have found momentum. The move reverses almost immediately, because the appearance of momentum was a mirage of thin participation. The fourth relationship is the one that professional traders watch for with the most disciplined attention. High effort, low result. Large volume produces a small price movement. This is the absorption candle, and it is the most powerful pre-move signal that exists in any market. When large volume appears and price barely moves, when the bar is tall in volume but small in price range, it means two large forces are in direct conflict at the same price level. One side is driving price in a direction. The other side is absorbing everything being thrown at them, buying every sell or selling into every buy, without allowing price to move. This is institutional activity. Individual retail participants cannot produce high-volume, low-movement candles. Only institutions, with the capital to absorb large directional orders without breaking the price level, produce this signature. An amateur sees a flat candle with high volume and concludes nothing is happening. A professional sees the same candle and knows that something significant is being decided right there. The absorption event almost always resolves in one of two ways. Either the absorbing side is eventually overpowered and price breaks through the level with force as the absorption fails, or the absorbing side holds completely and price rebounds away from the level with equal force. Both resolutions are tradable. Neither can be anticipated without reading the absorption event in the first place. Let me tell you about Omar. Omar had been trading for 18 months with a system built around breakouts, the same breakout logic covered in earlier videos. His entries were technically sound. His stop placement was correct. His position sizing was disciplined. His win rate on breakout trades was 39%, and he could not understand why a setup type with such clear logic kept failing at such a high rate. He decided to go back through 6 months of trades and ask one specific question about each failed entry. What was the volume doing in the 3 candles immediately before the breakout candle he had entered? What he found stopped him. 12 of his 14 losing breakout trades, more than 85%, had shown clear absorption signatures in the candles directly before his entry. High volume, minimal price movement. The institutional player on the other side of that level had been absorbing the breakout pressure for multiple candles before Omar entered. He was entering at the exact moment the chart was telling him there was a major defended level directly above his entry. He had been reading the price chart and ignoring the volume evidence that directly contradicted the breakout's premise. Over the next 4 months, Omar added a single pre-entry rule. Before entering any breakout trade, confirm that the candle immediately preceding the breakout shows expanding volume with a price range proportional to that volume, meaning no absorption. If the preceding candle showed high volume with minimal price movement, he passed the trade entirely. His win rate on breakout trades climbed from 39% to 61%. His average winner held at $480. His average loser fell from $290 to $212 because he was now entering cleaner breakouts with less institutional resistance immediately above his entry. His profit factor on breakout trades moved from 0.85, losing money net, to 2.4. One reading change. Not a new system. Not a new time frame. Not a new instrument. The change was in what he saw in the volume that was already there. Here is the mathematics of what that absorption filter actually accomplished. In the 6 months before Omar's change, he took 23 trades and produced a net outcome of approximately $260 of profit, essentially $260 across 6 months of real risk and effort. In the 4 months after adding the absorption check, he took 15 trades. 8 setups were filtered out because of absorption signatures and produced $3,000 of net profit. Fewer trades, dramatically better outcomes. Because the 8 filtered trades were not missed opportunities, they were avoided failures. The absorption signal had correctly identified in all 8 cases that a defended institutional level was directly in the path of the expected breakout. Not one of those 8 filtered trades would have resulted in a profit. Now let us understand why this is so difficult to see in real time. Because knowing the 4 relationships intellectually and reading them clearly at the moment of entry are genuinely different skills. Your brain processes price movement first. Always. The candle is kinetic and visual. It moves. It changes color. It creates a story that the brain's narrative system immediately begins interpreting. Volume is a secondary bar at the bottom of the screen. It does not move dramatically. It does not change color with urgency. It sits still while the price candle draws your eye upward. This attentional hierarchy, price first, volume as an afterthought, is not a bad habit. It is the natural visual processing order of the human brain. The deeper trap is what happens once a trader has identified a potential setup. At the moment of setup recognition, a small but measurable amount of dopamine releases in anticipation of the reward the trade might produce. That dopamine release creates a mild version of the same state covered in the post-win video, a state where confirming evidence is processed more clearly than disconfirming evidence. The absorption signal, high volume, flat price, looks to the primed brain like a lot of activity at this level, and is registered as confirmation rather than as a warning. The brain that has not yet committed to a trade reads the same signal as a clear barrier. The brain that has already decided it wants the trade reads it as additional energy at the level it wants to break. This is why professionals develop the habit of reading volume before forming a trade intention, not after. When volume is read before setup analysis begins, it is read with an uncommitted mind. When it is read after the setup has been spotted, it passes through a filter of existing intention that reverses its meaning. The protocol is not about the volume, it is about the sequence of observation. An amateur reads volume after deciding they want the trade. A professional reads volume before deciding whether a trade exists. Here is the 5-question protocol. Apply it before analyzing the price chart, not after, before. Question 1. What is this bar's volume relative to the 20-period average? Volume means nothing in isolation. A large volume bar on an ordinarily high-volume instrument is less significant than a large volume bar on an ordinarily quiet one. The 20-period average gives you the baseline. Every assessment of volume magnitude starts from that reference. Question 2. Apply the effort versus result test. For each candle you are reading, especially the candles immediately before your potential entry, calculate the relationship between price range and volume. Large range on large volume, conviction, clean entry possible. Large volume on small range, absorption, institutional resistance present, do not enter until this resolves. Small volume on large range, vacuum move, do not chase. Small range on small volume, compression forming, watch for the next signal. Question 3. In the context of a trend, check the directional volume ratio. Look at the last 10 bars. Are the bars moving in the trend direction attracting more volume than the bars moving against the trend? In a healthy uptrend, the up bars should consistently show more volume than the down bars. When down bars begin attracting equal or greater volume than up bars, the trend is losing internal health before price gives any signal. This is your early warning system for trend deterioration. Question 4. At every key level you are watching, support, resistance, trend lines from the prior video, look specifically for the absorption pattern. Multiple bars of high volume with price unable to break the level is not evidence that the level is weak. It is evidence that the level is defended. Defended levels break powerfully when they finally break, and bounce powerfully when the defense holds. The absorption tells you that a significant decision is being made at this exact price. Position for the resolution, not for the assumption. Question 5. Once inside a trade, monitor the volume on each subsequent bar. A trade moving in your direction should attract accelerating or at least consistent volume on each bar. When volume begins declining on successive bars moving in your favor, the move is losing fuel. This is not a signal to exit immediately in most cases, but it is a signal to tighten your trailing stop and prepare for a stall or reversal before price itself shows you the warning. The professional exits while profit is still intact. The amateur holds until price turns around and shows them what the volume already said 5 bars earlier. Read the effort. Measure the result. Position before the crowd arrives. Every trade you have ever watched fail while the volume told the real story from the beginning. Every breakout that stalled. Every bounce that reversed. Every trend that died before price confirmed it. Those moves were not unpredictable. They were predicted. By the volume. By the effort versus result relationship. By the absorption signature in the bars before the entry. The data was there. The framework to read it was not. What professional traders see in volume is not a secret system or proprietary information. It is a reading skill. Like learning to read music while everyone else is only hearing it, the notes were always there, the sheet was always visible, but the ability to decode what was written produced a completely different understanding of the same sound. The volume speaks on every bar. Now you know what it is saying. If you have ever entered a breakout that immediately reversed while the volume was trying to warn you, type absorption in the comments. And subscribe now, because the next video builds the complete pre-trade entry checklist, combining the trend line reading, the volume quality framework, and the position sizing rules from the previous 3 videos into a single protocol you run before every trade, every time, without exception. The chart always told you the truth. Read the volume and you will finally hear it.